In this week's video, we'll review the charts to help us answer the question, is the Trump trade about to come crashing back to Earth? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Clients know that our approach is to monitor hard data and adjust when needed, rather than anticipate and hope. And this little handy expression will be good to keep in the back of our minds as we review the charts this week. It's a daily chart of the S&P 500 index. This is calendar year 2000 here on the left side of your screen. Where your cursor is, we've removed price from the S&P 500 chart, and we're looking at daily moving averages ranging from the 30-day moving average in blue, which will be our fastest moving average, all the way out to the 275-day moving average here in grayish silver on your screen. Regular clients and viewers know that a full-bore bearish look is when blue, the fastest moving average, is on the bottom, and all of the slopes of the moving averages have rolled over, as they are here late in calendar year 2000. We can see this, we can monitor it, it's observable evidence, and we can measure it. This tells us that trends are aligning on multiple time frames, and that means our confidence is high relative to what we're seeing from a probability perspective. If we remove these moving averages and go to the exact same point in time, which is late in calendar year 2000, and just look at price, in this case the S&P 500 was hovering around 1315 when we could see the observable evidence that told us the odds, the risk-reward ratio, was not in our favor. What happened next? After we had the observable and measurable evidence in hand, the S&P 500 lost an additional 41%. In the next segment of the video, we'll use this information to see what the health of the present day market looks like. Similar situation here, the fastest moving average, blue, the 30-day moving average, is on the bottom here. I can see it, and all of the moving averages at this point have negative and bearish slopes, telling us that our trends are aligning on multiple time frames, from the 30-day all the way out to the 275. This too is a poor risk-reward look here early in calendar year 2008. If we remove the moving averages and just look at price early in 2008 at the same point in time, we can see the S&P 500 in this case was hovering around 1325 with the full-bore bullish look in hand. What happened next when we had that low probability look? The S&P 500 dropped from 1325 all the way down to 666, meaning after we had the evidence in hand, stocks lost an additional 50%. Therefore, we just went through the two examples when we had this look here before the dot-com bust really got into full swing from a bearish perspective, and this look here early in calendar year 2008, we know that from a probability perspective, that's not a good setup, and bad things in these cases happened after that. Does it mean that bad things always happen with a look like this? Absolutely, positively no. We're simply talking about probabilities here. This is a low probability look where we're going to want to place a high emphasis on capital preservation, and growth of our accounts will take a back seat. Therefore, in this week's video, we will leverage this quote from Market Wizards. In fact, it was the simplest approach that proved best. This is relatively simple. We can see it, we can understand it, and we can compare these looks to the present day to learn something. These are the exact same moving averages from the 30-day, the fastest moving average in blue, all the way out to the 275-day here. It should be noted, these are generic moving averages. These are not moving averages necessarily used by the market model. We do not use something as fast as the 30-day moving average. That's too fast for our longer term time frame. However, we've included it in this week's analysis to emphasize the point that we're getting similar information from multiple time frames. This is a bullish look, the 30-day moving average. All of them have a positive slope all the way out to the longer-term 275-day moving average. Just as our confidence was higher here when all of the moving averages were sending similar signals, our confidence is higher in the present day when we're getting the same read from the 30 all the way out to the 275-day. This quote from Market Wizards will also help us with this week's video. Someone can spend millions of dollars developing an elaborate interest rate forecasting model, and I'll bet you that over the long run, the bond market's forecast will be better. Here's the key. The general principle is that if you give up your ego and listen to what the markets are telling you, you can have a huge source of information. This is what the market is telling us as of Friday, January 13th, 2017. The present day really doesn't look anything like the toss and turn looks that we want to avoid, or these low probability looks. Similar situation with the NASDAQ. The more a chart looks like this or this, the lower the odds from a trend perspective and the more concerned we would be. There's really not a lot of concern on the chart of the NASDAQ as of Friday, January 13th. And remember, our game plan is to monitor facts, these are facts, and adjust if needed, rather than anticipate and hope. We're not anticipating or forecasting what's going to happen next. We're simply asking, does this chart look good today? And does it align with our present allocation? If the answer is yes, leave it alone. If the answer is no, we make some tweaks. Similar situation with the Dow Jones Industrial Average. The trends in industrial stocks actually look better. These are nice, sound, convincing slopes on these moving averages here, and there's no red flags, and this doesn't really look anything like this or this. We've been talking about and we've owned financial stocks since election day. This is what XLF looks like on Friday, January 13th, 2017. This is a sound look, multiple time frames from the 30-day here all the way out to the 275-day in silver or gray at the bottom. The fastest moving average is on top, and the slopes of all of the moving averages are positive. That's almost a mirror image of this concerning look here, where the fastest moving average is on the bottom, and all of the moving averages are rolling over in a bearish manner. Similar situation with economically sensitive consumer discretionary stocks, or XLY in the ETF world. We've covered energy stocks numerous times in recent weeks and months, and this is a constructive look as of Friday, January 13th, 2017. All things being equal, a broad rally where a high percentage of stocks are participating tends to be healthier than a narrow rally led by a relatively small group of stocks. This is the Vanguard Total Stock Market ETF. It's much broader than the S&P 500 in terms of the number of stocks that are included. And you can see VTI also has a constructive look on Friday, January 13th. How about an equal weight S&P 500 ETF, or RSP? This looks good too. We're not anticipating here. We're monitoring. If we're using this to monitor, this looks fine as of January 13th. Do all the ETFs look good, and is everything rosy? The answer, no, as of Friday, January 13th. This look here is similar to these full-bore bearish looks that we want to avoid. Our fastest moving average is on the bottom. Our fastest moving average is on the bottom here, and we know bad things happened after that, and we also have several of the moving averages having somewhat of a rollover look. They look like they're moving from positive slopes to negative slopes. What can we learn from this chart? Given we're looking at the chart of TLT, or long-term treasury bonds in the ETF world, this is a defensive investment, and this look here aligns with the other looks or risk-on looks that we've been covering in the previous slides. The same concepts apply to risk-on, risk-off ratios. In this case, we're looking at consumer discretionary XLY relative to XLP or consumer staples. And we also have that constructive look. This really doesn't look anything like this or this. If our game plan is to monitor and adjust rather than anticipate and hope, if we continually ask ourselves, what happens if? What happens if stocks pull back? What happens if the Trump administration can't get anything passed? What happens if a trade war starts with China? What happens if valuations become a problem? What happens if earnings don't come through? What happens if there's some unforeseen geopolitical crisis? The answer in all cases is if anything becomes a problem, the 30-day moving average at some point has to turn down. Even the 30-day moving average is positive on January 13th. If we have a long-term problem and any of those items become a problem, then this chart here will slowly begin to morph into something that looks like this. Notice this takes time to start to roll over here early in 2008, and it takes time for blue to migrate from the top to the bottom. Now blue is on the top. We're not anticipating anything here. One of the reasons why we're not tweeting a lot is the information that we have right now. This is leave it alone information. Don't waste a lot of mental capital on this market watching things move up and down every day. Right now, we should be saving our mental capital for something like this if it indeed comes later on or a few weeks, a few months from now. But right now, everything looks good. Let's quickly reinforce our concepts here. Let's double back to the 30-day moving average all the way out to the 275-day. We know what the ugly bearish look looks like. This is a constructive look historically. This is the bearish turn here before the financial crisis. And this is the bullish turn here in calendar year 2009 at the end of the financial crisis. Has the same chart compared today? We already know it looks good, and this looks a lot more like this than this. How about risk-on, risk-off ratios? Same situation. This is what we want to avoid. This is the leave it alone look. Things look constructive. Right now, in the present day, we have the leave it alone. Things look constructive in January of 2017. Similar situation with the broad VTI that we've looked at. This is the look we prefer to see. This is a higher probability look. And we can see the present day here looks very, very similar to this bottoming process that started in March of calendar year 2009. Is it possible that the market pulls back from a look like this, especially in the short term? Absolutely, positively, yes, it's possible. We don't anticipate that. If the data starts to turn, we will make the necessary adjustments. How about global stocks, which includes the United States? Here's the look we want to avoid. Here's the constructive and bullish turn in 2009. And here's the present day on January 13th. This looks a lot more like this than this, where blue is on the bottom and all of the slopes are rolling over. If we back out a little bit on this chart, you might see something familiar in here. It's possible that on January 13th, 2017, if we use the fastest moving average, the 30-day as our basis here, we have a bottoming pattern in global stocks with a left shoulder here back in calendar year 2015. The head is near the low in 2016, and the right shoulder formed here late in 2016, and it's trying to possibly clear the neckline in January of 2017. You can do some back of the envelope projections, which won't impact what we're doing in any shape, form, or fashion. This level here, if we break out, can be extended to the breakout period here to see how far this market might run. Like anything else, this pattern, and if it breaks out, speaks to nothing more than the probability of good things happening relative to the probability of bad things happening. Bad things can still happen with a constructive look like this. We also know from past videos that harder markets, and this is a 3.2-year consolidation box that dates back to calendar year 2013 for the Wilshire 5000, harder markets are often followed by easier markets. If you didn't see this tweet from our Twitter feed on January 8th, I think it's important. Here's a quote from Kyle Bass. He's an extremely successful hedge fund manager and very respected in terms of his research and opinions about the state of the global economy. Kyle Bass, today, global markets are at the beginning of a tectonic shift from deflationary expectations to reflationary expectations. Do we have any hard evidence in hand to back up that type of quote? The answer is yes. We can use TIPS, or Treasury Inflation Protected Securities relative to standard Treasuries IEF, as one way to monitor inflation expectations. This is your deflationary look here with the slope of this ratio falling. Then it starts to base, and then we get the final nail in the coffin for the Teutonic shift, or what we cited and called a radical shift on November 18th, and we also used the term on September 23rd, seismic shift. We can see things are changing here, we're basing, and we get a gap up here in inflation expectations after Election Day. When the broad market has a very, very strong trend like this, and especially after we've broken out of multiple year consolidation boxes, under our approach and using our time frame, we don't want to get too cute. We don't want to worry too much about what might happen in the short term. Why? When we have strong trends and after we break out of long-term consolidation boxes, often we get shallow and short-lived pullbacks. And if our focus is too short term, it's going to be very, very difficult to capture the gain in this case from point A to point B, which was almost 30% during a strong trend in calendar year 2013. The sum of these give-backs or head fakes was 37%. So we want to make sure, as long as the math allows, that we really don't focus too much on the day-to-day volatility and even week-to-week volatility. If the breakouts from the long-term consolidation boxes hold, we have to understand that the market's character can change. This is quite a bit different than the character in here during this 22-year period of consolidation. In this period here, you can get very, very used to worrying about pullbacks and volatility. But once you get the breakout, if you're constantly worrying about short-term pullbacks, it gets very, very difficult to capture the secular trend, which in this case is strong and bullish. After this 22 years of consolidation, the market's character was different for 17 years. Harder markets are followed by easier markets. Consolidating markets are basically followed by different markets. The market's character changes. If we fast forward to the present day, we were consolidating from 1997. The S&P 500 here, we were in a box similar to this box here. We broke out of that box in calendar year 2013. When we get to this side, we want our focus to change. When we get to this side, we want our focus to change. We still take it day by day, as long as the data that we have in hand still aligns with a strong secular trend. And it does. All of the charts that we've shown, from the 30-day moving average all the way out to the 275-day moving average, with the facts that we have in hand right now, align with something that looks like this or this. Is there anything else that aligns with long-term consolidation in the present day? The answer is yes. If we look at the broad NYSE Composite Stock Index, It entered this long-term consolidation box here in May of 1997. It revisited the exact same level for the most part at point B in 2003. Then we moved to the top of the box here at A1 in October of 2007, and we revisited that same level here at B2 between 2013 and 2016. Stock stayed inside of this box for an unbelievable 7,093 calendar days, or 19.4 years. Right now, it looks like we're breaking out of that box. This is January 11th of 2017. The longer we stay above the box, the more meaningful it becomes. The market's character inside the box could be markedly different than the market's character above the box. The market's character inside the box could be markedly different than the market's character above the box. All of that, of course, is to be determined, and that's why it's important that we pay attention to the charts and head into next week with that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.